President Trump preparing to meet with Chinese President Xi Jinping this week in what could be a turning point on trade. This comes after the market suffered major declines last week. Joining us right now is B. Riley Financial Chief Market Strategist Art Hogan. Art, it's good to see you.
Nice to see you.
How important is this Friday meeting between Xi and President Trump in terms of trade? What does the market want to see? And is anything here priced in terms of what might dictate market performance going into December and the next year?
No, I think only bad news on trade is priced into this market right now, and I think, only good can come out of this meeting. I think the fact that they've agreed to meet and talk about trade is a step in the right direction. I certainly think that the framework for a deal, or the ability to say, here's the things we need to iron out, a list of things that they've already gone back and forth on, would be very constructive for this market. I will tell you, Maria, the two biggest headwinds in this market this year, and certainly over the last month or so, have been the pace of monetary policy and fear that we might get too fast in 2019 on monetary policy, and trade, and that we might get into a mutually destructive trade war with China. If we can feel any relief on either one of those fronts, whether it's from Powell on Wednesday or certainly as we look at the conversation going on at the G20 meeting, I think this market could certainly have a whole lot more to do to the upside than to the downside.
Yeah, Dagan, that's what you said earlier. I mean, it's all gravy if it goes well, right?
It is all gravy, but there's something that Jonas Ferris said last week. He thinks that the concerns about the trade policy here in the United States and the fight with China is kind of a ruse for something bigger going on, as these central banks, the U.S. central bank reducing its balance sheet, but also the European Central Bank is on pace to end its bond buying at the end of the year. Bank of Japan also pulling back. So, Art, it's that removal of all that unprecedented accommodation by central banks around the world that is causing, in part, we're on track for the first time in at least a quarter of a century that global stocks and bonds could both finish the year in the red for the first time in more than 25 years, which is kind of incredible at the broad sell-off that you've seen globally in literally every asset class.
Yeah, Dave, it's pretty amazing. At the very same time, to put that at the feet of central bank policy is probably the wrong place. I think that you've got both an ECB and a Fed that stayed too low for too long and is struggling now just to get to a normal place, normalizing rates such that if we were to have some sort of global economic slowdown or certainly a recession in the United States, there would be some monetary policy to then give back. And I think that's where we're at right now. I certainly think both the ECB, who has been ultra slow at removing accommodation, and just now this year getting to the fact that the quantitative easing is going to come to an end, certainly not tight by any stretch of the imagination, and that the U.S. Fed is just very gradually walking into a place that's more normal. I think we've got another 50 or 75 basis points to go, and we're probably at normal here. And I don't think that that's what the markets are concerned about. I think it's messing up complex supply chains that have been put in place over the course of the last decade and a half, with tariffs that have no economic value. And I think that if we can get trade right and get to a better place in trade with China, I think this, the domestic and global economies will be looking much better.
Art, Mitch Rochelle, good morning. If the investors are selling stocks, they're selling bonds, they're selling virtually every asset class under the sun.
Oil, burlap,
Bitcoin.
That's in the journal article.
Burlap. They do mention burlap. So that means there's a ton, trillions of dollars of cash must just be sitting on the sidelines. How long can it stay there if you're a money manager and you're incentivized to generate a return? How long can you just sit on the sidelines in cash?
Yeah, Mitch, that's a great question, and it never stays there for very long. There is going to be some shift here at some point in time, and I think that when you look at what's been going on, you point to, Mitch, your point is very solid here, right? Everything's for sale, whether it's cryptocurrencies, stocks, bonds, et cetera, all the way down to burlap. I think when you look at what's going to actually happen, is you're going to see that we're very oversold. I think equities, both domestically and globally. I think there's going to be a strong case to be made for emerging market stocks as well as we head into 2019. But I think that all of this is going to pivot on the fact that we're going to have something constructive come out of the G20. We'll have a framework for a discussion, and then we'll have a deal first quarter of 2019. I think that that removes a bottleneck that investors have had for most of 2018, and we move forward into a much better place.
Well, there's the bottleneck on trade, but what about the bottleneck on rate hikes? I mean, the Federal Reserve already raised 3 times this year. We're expecting the next hike in the next couple of weeks when the final meeting happens this December. Fed Chairman Jay Powell set to speak this Wednesday at the New York Economic Club. And last week we had on this program Dallas Fed President Robert Kaplan. Here's what he said about interest rate hikes. Even he's saying we don't need the foot on the accelerator so much. Listen to this.
At this stage, you're going to hear me be much more careful and avoid being rigid or predetermined regarding our future moves. I think we might have some further moves to go, but I'm going to be very, in the lingo, data dependent and avoid, again, being rigid or predetermined about the path of rates and the pace at which we're moving. And I think that's appropriate at this stage in the cycle.
Art, he doesn't think the Fed needs to be so aggressive at this point. What do you think?
No, and I agree. I think, Maria, look back at the cycle we've gone through. The Fed started talking about raising rates in 2013. They didn't get around to the first increase until 2015, and this is the first year they've ever hit a target. I don't think they're going to go 2 years in a row at hitting a target, whether they think they need to raise 3 times next year or not. I think there's going to be enough evidence in the economic data stream with softness in housing, softness in auto, the sloppy Brexit, Italy and Brussels not getting along over a budget. I think there's going to be ample evidence for them to take a pause. And remember, next year, every meeting is live. They have a press conference after every meeting. So I just think the cycle changes in 19. I think we're back to maybe 2 more hikes next year, and that's probably as close to neutral as we're going to get before we have a downturn in the economic cycle.
By the way, real quick on that sloppy Brexit that you just mentioned, the European Union leaders are approving a deal for Britain to exit the EU. Prime Minister Theresa May now needs to get the deal approved by her own parliament. Is this going to be a market mover?
Well, no, because the market expects that not to go through Parliament on the first go through. Then that goes back to Parliament again. There's going to be another meeting of the leaders in the Eurozone in 2 weeks, and we probably don't see this get approved for at least a month. I don't think the first the run by Parliament, it's going to see it pass.
All right, here's Lee Carter.
So one of my questions earlier in the interview, you said that bad news is priced into the market. We've talked about a lot of things that are priced into the market already. Is there anything that could, you think, take everything or derail it in the coming weeks even more?
Well, I think if you saw, economic data have a significant slowdown, I think that would be the biggest concern. We haven't seen that. As early as last week, saw the leading economic indicators continue to show expansion. I think that, the 2 soft spots in the economic data stream continue to be housing and auto, but away from that, I think everything looks pretty steadfast heading into the first quarter next year. If we were to see a significant slowdown in the economic data stream, I think that would be the downside.
Sounds like you want to put money to work in stocks, Art. You're still positive on stocks?
Oh, absolutely. I think we're going to have a very solid 2019. I think we're very oversold in the short term.
Art, great to have you on the program. Thanks so much.
Thank you.
Good to see you, as always. Art Hogan there.